Your friend just showed you how much they made by investing in some random dog coin crypto something. You saw a Reddit post about someone buying an apartment with the proceeds of their investment in lean hog futures. Your dad just messaged you about a startup drone company that's been taking off lately. And no, it's not one of his usual puns. This doesn't feel good. In fact, it can actually be quite dangerous and cause you to stray from your path of sustainable wealth building into all sorts of different fields of investments that you simply have no clue about. This is FOMO, the fear of missing out. In this video, I'll show you how I will, hopefully, never suffer from this ever again. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discuss is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. First up, what is this FOMO and why is it important to avoid in investing? FOMO, or fear of missing out, is when investors feel anxious about not joining others in profiting from a particular asset, leading to impulsive and often poor investment decisions. Acting on FOMO means skipping through research, which can result in overlooking risks and making uninformed choices, and this behavior can lead to buying assets at their highest prices and selling when prices drop, which goes against the basic investment principle of buying low and selling high. Emotional decision-making driven by FOMO can cause stress and lead to seeking only information that confirms one's decisions, ignoring important facts that show that you might be wrong. Following the crowd or herd mentality often leads to overcrowded investments, reducing profit potential and possibly creating market bubbles where asset prices are way above their true value. When these bubbles burst, sharp losses can occur. Focusing on hot, trending assets can cause investors to miss out on better opportunities and neglect diversification, putting too much money into one asset or sector. Obviously, suffering from this FOMO isn't great for wealth building for the long term. In the worst cases, it can lead to investors to stop investing completely. So how do I avoid it, and what's this? If you're new to the channel or never come across this model, then I made a video going over it and how it all works, which I'll link in the cards here. If you have seen it before, you'll know that this metronome is a representation of how I organise my portfolio. It works like this. 4 legs, and these are the 4 important things you need to have before you even start investing. The base and ticker, and this is the income that fuels the rest of your investment and potentially your lifestyle later on. The middle, this is the set and forget part of your portfolio. The tip, here are the risky bets, and this should only be about 3 to 5% of your entire portfolio at max. But what has all this got to do with FOMO? Well, each stage has some link to FOMO and how to avoid it. Let's go through each stage and how they link to avoiding the fear of missing out. The 4 legs. The 4 legs that support the metronome portfolio are income, emergency fund, knowledge, and emotional balance. Income is necessary as it's the main flow into the portfolio. It doesn't have much impact on FOMO though. Most people who suffer from FOMO will have an income, and that's part of the problem really. So we'll move on from that one. Emergency fund. Now this is very important for investing as it provides a safety net so you don't need to interrupt the compounding of your investments. Again, it's not really applicable to FOMO or avoidance much at all. Knowledge, however, is key. It's important to know that generally the people who make the money from these type of fast rising investments are few and far between. By the time you've heard about it, it's probably too late anyway. Often the ones that do benefit end up holding on for too long and ride the fall back down too. This happened more than you'd expect with the big stories with cryptocurrency, for example. Now, if you only see the people bragging about the gains, but never mentioning their losses, you're naturally going to think that everyone is winning except for you. And again, naturally, people are only going to want to share their positive investments as it protects their ego. This leaves a situation where people are only sharing the fast money-making plays, and you're comparing it to your own situation. Just like on Instagram, people are sharing their highlight reel. And the first step to combat that is knowing that this is the case. Then the final leg lines up nicely with this knowledge, and that's having emotional balance. Emotional balance means you need to be mentally prepared for your portfolio to experience a 50% downturn at some point. It means that you have a plan and you're content with the outcome of it. It's quite simple, but it's not easy at all. It goes against all the psychological traits that humans have evolved with. And talking of a plan, that's where the rest of the metronome comes in. Let's move on from the legs now onto the base. The base is the main part I talk about on this channel really, as it's where the dividend experiment comes into play. This is the income investing side of the portfolio, and the goal here is to first calculate the amount of money you would need to live a minimum viable lifestyle. If you're not sure what this is, then you'll definitely want to check out the full metronome portfolio video I mentioned earlier, as it's easy to get this meaning confused. Once you have the minimum viable lifestyle target amount, then you work towards building a portfolio that pays your bills, the motto of this channel. Now, how does this help with FOMO? Working on this in and by itself is incredibly rewarding, and it hits similar dopamine levels as chasing gains. In fact, it's much better as the results are a stepped increase in income every time you add more to the portfolio. The 1p dividends become 10p, the 10p become £1, the £1 become £10, etc. This is possibly why dividend investing is so popular, as you can see the growth in income over time. If you wanted to then take out the money from the base of the portfolio to invest all in some biopharmaceutical, electric vehicle penny stock, you'd have to reset all of your progress so far. When you're building a dividend portfolio, rightly or wrongly, it does feel as though you're building something. And psychologically, that is huge. I've posted this before, but here's my progress over 5 years of dividend investing. Now, this isn't a get-rich-quick kind of thing like the FOMO type things that are attractive, but instead, once you start building it, it becomes difficult to undo your hard work. If you want to see the current dividend experiment portfolio, or at least a rough approximation of it, I have it on eToro, so you can view all the things that I'm holding live and how well they've done. I'll link to that in the pinned comment, and full disclosure that is an affiliate link, so if you do use it and decide to sign up to eToro, then it helps the channel a lot, so I appreciate that. If you already have an eToro account, then it should take you immediately to my profile, so you can have a look if you feel nosy like that. Okay, let's move on to the middle. Now, the middle is where the bulk of your investment deposit ends up, ultimately. It's also the simplest one to deal with as there's relatively few choices here. You basically select an index fund ETF type investment that covers a broad range of stocks, possibly even across multiple stock markets. My personal preference at the time of making this video is Invesco FTSE All World UCITS ETF Accumulating, or ticker symbol FWRG. To summarise, it's an exchange-traded fund that tracks the FTSE All World Index, providing diversified exposure to large and mid-cap stocks across both developed and emerging markets globally. As an accumulating fund, it reinvests dividends, potentially enhancing long-term returns through compounding. The ETF is UCITS compliant, ensuring adherence to EU regulatory standards for investor protection, and offers a cost-effective liquid option for investors seeking broad global equity exposure. So basically, I buy this and then don't really think about it again. Now, you might prefer a different specific ETF or a combination of them even, but the premise of the middle of the metronome is the same. It's basically a set and forget portfolio that you put excess investments into. But how does that avoid FOMO? It's a bit tricky, but it comes down to this. Only a very small number of actively managed funds can beat the stock market over the long term. These have a large amount of resources, information, and even staff working on doing exactly this. You don't. It's going to be much harder for people like us to beat the market, so if we can't beat it, why not join it? This kind of goes to the concept of no mind that's popular in Zen Buddhism and Eastern philosophy. I did say kind of, where if you want to seek peace, then it's better to have no mind. This kind of investing is about as close to peace that you can get, I would guess. Now let's move to the final part of the metronome. The tip. This part is the allocation of the portfolio where you can take on the risk, which serves as a contrast to the other sections. It acknowledges the human nature of wanting to take higher risk for potentially higher rewards, and this section includes high risk, high reward type plays that may tempt you, such as hyper growth stocks, penny stocks, moonshot type plays, and even cryptocurrencies. However, it's important to keep the tip to a minimum percentage of your overall portfolio. It's recommended that the tip section should not exceed 5% of your total portfolio, preferably less than 3%. If you prefer to skip this section entirely, that's entirely up to you, and can be a wise decision. However, many individuals enjoy taking bigger risks or exploring moonshot opportunities with significant potential rewards. The key is to manage these risks in a way that won't jeopardize your entire portfolio or hinder your overall progress. The reason the tip section is not extensively covered in the Dividend Experiment YouTube channel is that it can be irresponsible to showcase the tip content without explaining the rest of the portfolio. I do, however, think it's important to have it as an outlet to let the human desire to make the risky plays. It's an allowance to do just that, but at a percentage of your overall wealth that doesn't completely eradicate your progress in an unhelpful way if it goes wrong. How does it avoid FOMO? It leans into the same primitive ape-like urge that humans have to take risks and get bigger and better rewards, but in a controlled and organised way. It won't make you a crypto billionaire if you only allocate 3 to 5% of your portfolio to some next altcoin the guys down the pub were talking about, but it won't flatten you either if it goes wrong. And let's be honest, the odds are probably ultimately not in your favour anyway. And this doesn't mean you have to invest a little chunk of your portfolio into something stupidly high risk just for the sake of it. Right now, at the time of making this video, I don't have anything taking up this part of my portfolio. It's just base and middle right now. So, does it work? Well, I guess only time will tell for something like this, but so far so good. A big challenge will have been seeing people make huge amounts of money on stocks like Nvidia recently, which is up 122% year to date. Now, Nvidia is a company that I thought was well run and is in an industry that is likely to be in demand. It's reasonable that I could have invested in it and missed out. But here's the thing, it didn't fit my plan to invest in it as an individual stock, and it's a component of the ETF in the middle that I talked about earlier, so I don't feel the need to beat myself up or join in on the hype. In fact, I don't feel much of anything about it at all. You can't lose money on stocks you don't own, and it's better to stick with a well thought out plan that suits your own goals. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!